One giant leap for mankind.
Radio Cayman in the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
And warm welcome to Money Sense. I'm Simon Cawdery, and I have the distinct pleasure of welcoming David Slatter to the show this morning. David is a brand new guest on our show, so thank you for joining us, David, this morning.
Well, thank you for having me, Simon.
Absolute pleasure. Look, David is for those who don't know David is the Group Head of Investments at RF Bank and Trust. And David has rather bravely, about a month or two ago, rather bravely agreed to join us to discuss markets and financial events, shall we say. That was a month and a bit ago. When we sort of prepped for the show, we talked about things are a little bit difficult. Markets have been experiencing, shall we say, some weaknesses. A month's gone by and all that's disappeared. So perhaps you could help us do some sort of debrief as to what sort of a whirlwind of 6 weeks we've been experiencing.
Maybe it's kind of this idea of the art of the deal, right? So you create a crisis. And then you provide a solution, and everybody seems to feel euphoric about it. And suddenly, all those risks that are still out there seem to be downplayed, despite the fact, in my opinion, the world is a riskier place now than it was on March 31st, for example.
March 31st being the key day, right? Well,
let's just say that's a month end before the big L day.
Yes.
Right? Yeah. So, I mean. Yeah, so I think the markets may have gotten ahead of themselves, in my opinion.
Mm-hmm. We started the year at a price level, let's say on the S&P or the Dow Jones, almost all indices have the same characteristics in the US, which was level A. Then we went down 20% or thereabouts, and now we're basically back to where we were. But I think I heard you say that you think the world today is a riskier place now than it was a month or so ago when markets were at their sort of cratering position. And yet markets have sort of said to you, well, you might be right. It might be a riskier place, but what do we care?
Well, let's think about, say, the tariff policy of the U.S., right? And let's say we've got this 90-day reprieve with China.
And just to interrupt, the 90-day reprieve still is at tariff rates that are higher than they were.
Absolutely. So, still much higher than they were before. What are the scenarios? You can have kind of a low tariff scenario with China at 15%, or you can be around 30, or you can be around 50. So those are kind of the scenarios that you're going to have between U.S. and China, the two largest economies on the planet, right? And if you think about global trade and its impact, its importance in global GDP, a tariff on trade results in a reduction in trade, results in a reduction in wealth creation. It creates inefficiencies in the markets. So these are not positives.
And increases prices in a time when people are, or have historically been worried about rising price levels, cost of living, all those sorts of things.
Well, if globalization over the last 40 years resulted in lower prices and greater selection, when you reverse globalization, what do you get? You get less selection and higher prices. You get slower growth, not faster growth. So these are not positives, in my opinion. So this idea that suddenly what's really good for the U.S. and whether this is good for the U.S. is actually questionable, right? So this idea that onboarding of manufacturing jobs is, at the end of the day, if you look at what's going at the cutting edge of manufacturing, it's less and less labor intensive. You talk about dark factories in China where it's all automated. The lights are off, other than when a few guys come in to make sure everything's still running smoothly.
Put some oil in the machinery.
Yeah. Is there, make sure the programming is working correctly. So if the U.S. is going to be competitive with those entities, they're going to have similar levels of technology being used. So it's not going to be this massive increase in U.S. labor, perhaps, that is being sold to the electorate.
So what's the motivation, perhaps, then? Because it seems almost as though there's a hark back to shall we say, a bygone era when people worked their 9 to 5 shifts and came home and they had a job, and and the rose-tinted spectacles look at it and go, well, that was great. We all had jobs. The fact that some people would die of lung cancer down a mine because of the job, or some people would have back injuries because of the job. Those sorts of negatives are perhaps ignored. So why do people want to hark back to that sort of bygone era?
It's kind of this, I don't know, people become a bit romantic, and their view of what the past was is far more glamorous and comfortable and enjoyable than perhaps it really was. And so, I think, unfortunately, the reality is going to come home. And you see, for example, in the news cycle, that more and more people who perhaps were supportive of that administration are a little disillusioned, right? So whether it's you're a farmer in Iowa, or you're in a mayoral race in Omaha, Nebraska, like we saw the other day, that flipped. The mayor was there for 12 years, represented the Republicans, was defeated by a Democrat. Not that I'm talking politics, but just to show you there is a changing mindset within the American populace, that we'll see how that plays out in next year's election cycle, and the ability of the Trump administration to push through what it wants. So I think maybe they see that, and it's going to result in them being even more aggressive in trying to push through what they want to get done in this year.
So one of the things that's been top of mind, perhaps to people in Cayman when they read the local paper here, one of the topics has been what's been the impact of what might be the impact of tariffs on the cost of living. Cayman, like all Caribbean islands, has a very high cost of living, which has gone up over the last 5 years or so, quite significantly. Now, you mentioned tariffs, whether they be 10 or 15%. Logically, and forgive me for being somewhat logical here, but that means that prices are going to go up 10 or 15%. Is
Absolutely.
that not? What am I missing?
Well, economics 101, your demand and supply curves, right? So the supply curve, when tariffs come into place, shifts upward and to the left. And when that happens, what happens? Quantity demanded goes down and prices go up. And what you have is the increase in tariffs, what does it do? It does generate some revenue for the government. It generates a little more, surplus for domestic producers, sorry. It's a loss for international producers, but it's a deadweight loss overall. All right, so it's not good. It's not good for the economy to throw into the market this artificial structure, right? So it's just, once again, going to lead to, as you mentioned, less demand and higher prices, lower economic growth,
which rears the ugly word of stagflation. And perhaps we can sort of talk about, first of all, what is stagflation? Why is it a risk? Because one of the one of the main economic debates, I suppose, at the moment is between the administration, who says we need to have lower interest rates to spark economic activity, and the Federal Reserve saying, well, hang on a second there. You're talking about putting prices up. Our mandate is to control prices. So talk me through the maths and not the maths, but talk me through the mechanics of that then.
So I think the Federal Reserve has two mandates. It would be to control inflation, make sure it's stable, and also employment, right? Making sure the labor markets are running as smoothly as possible. That's the challenge right now, right? With tariffs coming in place, as the expectation may be higher inflation, so the Fed has to be on the sideline. They've used the word uncertainty so many times in their most recent press releases that that's kind of the word of the day, uncertainty. So they're uncertain about what inflation is going to look like. They're also uncertain about what the labor market's going to look like. So those two forces are going to dictate when the Federal Reserve comes off the sideline. Now, a big part of inflation would be the price of oil. We've seen that's been coming down. And if the U.S. does a deal with Iran, a quote-unquote deal, and they're allowed to put more oil into the market, if once again Russia's allowed to put more oil into the market, then of course you could have a supply of oil resulting in a decrease in the price of oil. That would be good for controlling inflation. But at this point, as I mentioned, the word is uncertainty, right? So we'll see. I mean, in March, with the expectation of the tariffs coming on, there was kind of this massive surge in importation. So you saw trading numbers shoot through the roof, especially
sort of like a fake boost to growth, or not a fake, but a temporary boost to growth.
Kind of like the irrational purchasing in COVID, right? I expect the shelves to be bare, so I better get it now. Yeah. If I want to make sure I have stuff on the shelves, I need to import it now. And I think you may see with some of the tariffs coming down, kind of a replay of that, not to the same extent, but the expectation there may be higher tariffs down the road. So once again, let's get what we can import it now. So we have our inventories built up.
I think, was it last night or was it this morning, Walmart came out and I think it was Walmart, and forgive me if it was another company, but they said they thought the impact of tariffs on prices and inflation was still to come. Because I guess to your point, you've bought a lot of products in at the price before tariffs. So there's a lag before the impact of these disruptions cause on domestic consumption prices. But that's going to happen. It's inevitable.
I'd imagine that whether you're talking about countries like Canada or you're talking about jurisdictions like Cayman or the Bahamas, when you see your supply lines, the reliability of how you get your supply of goods and produce challenged. Maybe you look for alternatives. You start to say, is there a way to perhaps ship directly from China to the Caribbean and redistribution within the Caribbean? So, for example, in the Bahamas, in Freeport, they have the container port there. So could that be a regional hub where ships go straight there and then distribute within the region? Could you source directly from Europe and not go through the middleman in America? So where you can, you'll try to cut out the middleman who may be controlled by an administration that could be adding a risk to you, right, your jurisdiction. So it just makes sense.
One thing, when I'm hearing you speak there, we talked a little bit about the oil price, and given how isolated some of these islands that we all live in are, in the sense that everything has to come in by boat or everything has to come in by air, the cost of transportation is actually a lot higher in Cayman than it is in a domestic economy where, say, US or Europe, where things go by road. And so the actual fraction of the final bill that is the transportation cost is a much higher proportion. So in a sense, the slowdown in economic activity around the world and the overproduction of oil could have a ironically beneficial impact on some of the Caribbean islands.
You make a good point, and that's why it's so so difficult to actually predict where things are going to be. But you're absolutely right. So if there's a reduction in oil prices due to overall slowdown in economic growth, then, as you say, the cost of getting goods to islands like the Caymans or the Bahamas or other parts of the Caribbean goes down. So there's always a silver lining under every dark cloud, I guess, right?
Well, let's go back to talking about markets, because this is the most puzzling situation at the moment. Markets are where they are today, which is where they basically were at the end of last year, and as close as damn it. Where are they going to go from here? Because you've used the word, well, you've highlighted that the word uncertainty has come up in the Federal Reserve's own language, and no greater authority on where the markets or where market conditions might be than them, perhaps. So if they're using the word uncertainty as though it's the only word that's germane to the conversation, how are we all supposed to figure out where markets are going to go?
Yeah, and if you go on earnings calls of companies, right, uncertainty, and some of them have actually, they're not even given guidance, right? Yeah. So because it's so difficult to determine. So, I mentioned to you before we started, like, for example, one of the entities we use for our research is Morgan Stanley. And if you look at their forecast for the next 12 months for the S&P 500, between their bear and bull, is a 50% spread. So they're very uncertain about where they see the S&P 500. So if Morgan Stanley's uncertain, the Fed's uncertain, really what in my opinion, that means that there's additional risk to be factored in. So one needs to become a little more conservative. One needs to perhaps P multiples that seem a bit rich based on historic levels. Maybe it's time to reduce your exposure to that part of the market. Maybe you're looking for equities that have lower betas, so lower market correlation. When it comes to interest rates, shifting your duration more towards, the shorter end of the curve. That's what we've done. So our view is, somewhere in that 2 to 5 year duration range is appropriate in the U.S. Treasury market. Less high yield, more investment grade, right? Because if you look at some of these multiples, the S&P 500 is still trading at over like 21.5 times forward earnings. All right, so the average is 15. That's on a basis, a typical expectation that earnings will accelerate and grow. So an earnings yield of 4.8%. Yeah. But the yield on the 10-year Treasury, on the 30-year Treasury, I think it's 5%. Yeah. The 10-year is more like 4.6. So Is that a bit rich? In my opinion, it's a bit rich. But, you never get completely out of the market, right? So regardless of whether you think the S&P 500 is a bit rich, you still need to have exposure to that because it is the largest equity market on the planet. But
your approach I'm hearing then is as almost as challenging as the outlook might be. You still got to be in the market, but perhaps be a little judicious about where you are within the market.
So diversification is the word I'm using the most, right? So the Fed is saying uncertainty, my view, is diversification, and that includes geographic diversification. So adding some European equity exposure, Asian equity exposure, and Japanese equity exposure, I think would be prudent from a diversification standpoint. Also, certain sectors, if you look at the PE multiples today versus historic levels, within the U.S. market, there are a few sectors that are reasonable. Healthcare, utilities, and...
Well, healthcare obviously has its challenges. Well, one potential challenge with healthcare at the moment is...
yeah.
Well, yes, the pharmaceuticals. And also, is it United Health, which is being investigated for Medicare fraud? So there's challenges wherever you look. There's almost landmines waiting for you to stand on them, aren't there?
And that's, if you're going to go into those underlying sectors, then you look at ETFs to get diversification, right? So trying to pick, you're right, there's a risk of picking the wrong one. So if you go into, say, an ETF that's S&P 500 utilities, financials, and healthcare, that's where we're looking at adding some gold, adding some silver, right? So, for example, let me ask the question. So if you've read Ray Dalio's The Changing World Order or Fareed Zakaria's Age of Revolutions, and reserve currencies come and go. Now, granted, what is the time frame, right? Is it 80 years, 100 years? But would you say that the end of the U.S. dollar as the reserve currency, its life cycle, do you think it's extended or shortened? My view is it's shortened. Now, is it 5 years, 10 years? I don't know. But, its reign as the reserve currency will come to an end at some point. What replaces it? That's the big question, right? That's why the idea of having equity exposure to other parts of the globe gives you some of that currency exposure too, right? So if you're in the European market, if you're in the Asian market, if you add some gold, add some silver, it's once again, it's a way of saying, how do we diversify away from just the U.S. dollar exposure as well?
There'll be people clamoring for me to ask the question about digital assets as an exposure. I'm gonna refrain for just a moment because I want to. I'll put that little seed in your mind. We might come back to it, but I want to sort of almost throw a hypothetical at you, which is the Fed, as you say, has characterized the world as uncertain. It's also not done anything. Other central banks have done things. So the UK central bank, the ECB, the Japanese central bank, they've all done something, which is cut their interest rates, trying to recognizing that there's a disruption to economic activity. So the question, I suppose, is, do you think that if the next move in the Fed is almost certainly down, I presume, but let's say the Fed does move down, whether it be this year or next year, do you think that's a sign of confidence that the market participants should go, great, we should buy on the Fed's move? Or do you think it would more likely be a sign of, heck, things are getting pretty bad with the Fed's having to cut? So which side of the fence do you think you might be inclined to sit on that conversation?
So, there's other economists or research institutions that we use as well, and one that we use on a daily basis. That entity's view is that the Fed is behind the curve. In other words, they're taking too long to start reducing rates. They think that they will start reducing rates, but it's going to be later than they should have, and it's going to be sharper than it would have needed to be. And so they're somewhat bullish on treasuries, but more of that 5 to 10 maturity window. My expectation is that, yes, the impact of tariffs, the impact on slowing growth will start to feed its way into the numbers of GDP growth, into the numbers of the labor market. And you'll see the Fed, in my opinion, switch from this staying on the sideline to starting to lower rates. And if you look, as you say, other parts of the world, they're doing this, right? They've already started this process of lowering rates. So I think you'll start to see the Fed take action, but it's going to be a bit late when they start doing it. But so what does that mean?
Yeah, how will markets respond to that?
But what does that mean? So a steepening of the yield curve, right? Because I think given the fiscal situation in the U.S., markets are going to demand higher yields when you start going out on the yield curve, and the Fed starts lowering on the short end. So, you could have a steepening of the U.S. yield curve, and really the mid part of it, I think, is the sweet spot, right? Because you're not overly exposed to the potential volatility as you go out into the 30-year paper. And on the short end, I mean, as rates come down, you could even start having some capital gain benefit even in the 2 and 3 and 4 and 5 year maturity area, part of the curve. So I view that as a sweet spot, that 2 to 5 year duration window, and just laddering securities. I've got, a whole series for the funds that I manage. I've just got, laddered positions, and as they mature, just roll them out to the end of to the far end of the ladder. That's all.
Now, you mentioned something there which I want to slightly tongue-in-cheek tease you on a bit, but the debt window, the debt situation in the US. I didn't think anyone cared about debt anymore. It's borrow as much as you want. It's that old concern is out the window. No one seems to care. I mean, there's always a debt crisis in the US which gets resolved a couple of weeks later, and the debt level goes up another 20 notches on the scale. But everyone seems rather calm and subdued about the whole thing. This isn't like, was it 15, I've forgotten what year we're in now, but 20 years ago or so, when we had the European debt crisis, Italy, Spain, Greece had debt levels which are lower than they are in the US right now, and there was chaos and panic on the streets. So why should we care about debt anymore?
Who's the only adult in the room? The bond market, right? Yeah. They're the only ones the bond market is the one that reacts in a way that seems reasonable. And there was a scare that the Trump administration was exposed to when they did their Liberation Day, quote unquote. You saw the bond markets react, and they immediately had to pull back, right? So I think that, you could see that it'll be the bond markets that will send the message to the U.S. administration that, you can continue to run these large fiscal deficits, but the interest rate you're going to have to pay is going to go up. And that will be the moderating factor. Well, simply the fact that, oh my goodness, how much do we have to pay?
Because the interest, so what you're saying is, if the bond market takes umbrage with what's going on, interest rates on the debt go up, and then all the policies that they want to enact domestically, all that cash is swallowed up just simply paying the interest bill.
Well, right now, it's expected to be $1 trillion next year, right? Yeah. More than the defense spending. Yeah. All right. So, but defense spending is expected to go up. So, what'll happen, what'll happen, I love that. What may happen is that you see interest rates going up on the longer end of the curve, and therefore more of the debt being raised at the shorter end of the curve. And there comes a point where it's just no longer sustainable. And that's the trend that's happened in the past, right? That's the issue that whether Ray Dalio in his book talks about, the changing world order, that it's just a matter of when. It's not a matter of whether. It's when. Like cycles happen, right?
But cycles, in a sense, annoyingly as a sort of from an economics profession, annoyingly the cycles have got sufficiently long that you almost forget when the cycle started because the end hasn't yet happened.
Yeah, you're right. I mean, we as humans, our life cycle is, kind of like one of these cycles we're talking about. So
my attention span is much shorter today than it was 10 years ago because of social media. So I want I want to be able to see the cycle happening.
Yeah, the ability to step back from it and look and say, wow, what's really going on here, Because I was just thinking about a kind of an analogy, right? Liberation Day, quote unquote. Imagine you're on a relatively calm lake, but you don't throw one big stone in the lake. You throw 180 stones in the lake, now different sizes. China being the biggest, Canada, Europe. The ripples start, right? What happens? Some of them offset each other, some magnify. And if you're at the other side of the lake, you're not exactly sure what you're going to be hit with, but at that side of the lake, there's going to be erosion. And think of global trade as the shoreline. It's going to get eroded. And so there'll be less global trade. Back to what we talked about earlier. All right. So regardless of, what you think about this short-term effect that long, what's going on right now will have a dramatic change for years to come on global trade. Would you say that the world is more confident in the U.S. administration or less confident? Obviously less confident, right? I mean, you've had basically relationships that in a matter of weeks have been flipped, all right? to think that those other entities are just going to take it. Now, granted, in the short term, yes, they, for example, Canada's pulled back tariffs on the U.S., right, because it's not in their interest to do that. But in the long term, you can rest assured that those countries are thinking of other ways to diversify their trading relationships, to if they're going to expand their defense industry. I didn't mention defense, right? That's another big pillar of what we've been recommending for our clients, whether it's European defense, U.S. Defense. South Korea has a very impressive defense industry as far as producing armament and munitions and submarines. Those countries, instead of buying from the U.S., will look to other parts of the world to buy their defense needs, right? So it just makes sense. If you slap me in the face, you think I'm coming back for a drink? I may have to come by, and we may have to have a conversation because it's part of business, but I'm not going to choose to come by, right? So
it's always intrigued me, the scenario whereby the actions that are going on right now, and I agree with you totally on what you're saying there, but the longer term consequence could very easily be a quickening of the reorder of the world, in the sense that the acceleration of the non-utilization of the dollar will most likely increase now, because people will be a little bit more anxious. The reintegration or the integration of China into trading patterns will accelerate, because people will consider that China's angst that it causes countries hasn't changed. The US's angst has increased, and so therefore on a relative basis it's become less angst inducing, I suppose. So it will actually accelerate friendships which are probably considered undesirable from the current administration.
I think you're right. I think there'll be relationships that are expanded that perhaps wouldn't have been the case in 2024, but today they will. And it's out of necessity in certain cases, right? So, I keep going back to the Canadian example. I'm Canadian and Bahamian, so I'll go to the Canadian example. That right now they're thinking, how do we get our oil, how do we get our natural gas to Europe, to Asia, and less so to the U.S.? That's sold at a subsidized price, just for the record, eh? So they buy it at a discount, and then they refine it and sell it at a significant markup. So this idea that there's the Canada's taking advantage of the U.S. is a joke. But whether it's Canada or Brazil, Brazil provides a lot of commodities to China. The flow of beef, soybeans, coffee, all these things are increasing. So China's also, they're looking for alternative sources for trade as well. So you can have these discussions, and there's no deal has been done yet, eh? This idea that there was a deal with the UK, no, there was a
deal to have a chat about what the deal might look like,
right?
Which is, define that in whatever way you wish, but that's not a deal.
And that discussion annoyed the American automakers tremendously, because they're like, at the end of the day, these British automakers, even if it's a quota of 100,000 units, their product's going to be less expensive in the U.S. than our product, because we still need to import a lot of the inputs in our automobiles, and there's tariffs on the blah, blah, blah. So this idea of these ripples and where they end up, it's uncertain.
Yeah. Well, we're not uncertain about one thing, which is the time on the show, and we've got about 30, 40 seconds. Perhaps just a last parting word from you. Just what's your level of optimism about Caribbean economies, whether it be Cayman, Bahamas? Are there green shoots? Or are you perhaps more nervous? Where do you stand on that conversation?
Cayman is kind of an entity onto itself, right? Its ability during COVID to continue to attract high net worth individuals who are looking to invest in real estate or invest in the financial services products, that's going to, I think, continue. On the tourism front, yeah, I think you will see, if you're dependent on American tourists, there's going to be a pullback. So in the Bahamas, for example, stopover visitors, they've been in a decline, right? So still, very healthy numbers, but decelerating year over year. The cruise industry has been booming in the Bahamas, right? So Newport, those numbers are up.
For the love of anything, don't mention the cruise. Don't use the word cruise on this show. We've avoided that for 2.5 years. We're not bringing it up now.
We've already taken the medicine in the Bahamas, so we won't talk about it anymore. So my view is it'd be reasonable to expect slower economic growth. The possibility of recession in the U.S. is now in that 40 to 50% range, whether you speak to the Atlanta Fed or you speak to many of the pundits out there. So it's reasonable to expect that the probability of recession in the Caribbean is higher than it was.
So
4 months ago.
If you're advising someone in government, just your message is a little bit, be prudent and be cautious with what you're doing.
Be prudent, be cautious, whether it's the government. Be prudent, be cautious, whether you're an investor. Take some risk off the table.
Because it's uncertain out there. Sorry.
That's the word, right? So fully agree. So I don't expect it to be a deep recession based on what I've been reading, but if there is higher probability, there will be a recession of some kind.
Well, look, David, our time, unfortunately, is always too limited on Money Sense. We have come to the end of it. Thank you very much for joining us. Your first appearance. We hope it's not the first and only. We would love to have you back. So thank you again for joining us this morning.
Thank you, Simon. Thank you, Cayman. I'm more than happy to come back whenever you need me.
Fabulous. As a final note, I've got two final notes. Just the first one, just to wish to thank our listeners for tuning in and remind you, if you have a topic that you wish us to cover, send us an email at moneysense@cfacayman.ky. And the final note is to wish a different David, my father, in fact, a happy birthday. It's his birthday today. So if he's tuning in, happy birthday, Dad. With that, thank you once again to all our listeners for tuning in. Goodbye, and please do tune in to Money Sense in 2 weeks' time.